Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. This episode is for the week ending March 16, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So we're through quadruple witching options expiration week, and the market was wedging lower all week long, closing below the 50-period moving average on the daily chart. The question is that significant with the 20 right below it? Probably not so significant, since just the last 10 minutes of the trading session, we saw the market take a little bit of a dive, and that had to do with options expiration and rebalancing of the indexes. We're not going to read too much into that. We're going to look at the bigger picture leading into this coming week, the following week, where we do have a Federal Reserve or FOMC interest rate announcement upcoming that will be announced on Wednesday. So there's a couple of things that go on when interest rate increase potentially, and that's what we're expecting. The market is expecting a 0.25% interest rate increase. Now, that's not a big deal in the big scheme of things. The Fed really is long overdue to begin raising interest rates off the bottom, which they have begun to do, but really in a slow fashion. But what happens leading up to that is the market tends to get quiet, typically on Tuesday and Wednesday leading up to the announcement. The market tends to float around in anticipation of what the Fed is going to do and what the Fed is going to say. So we can expect, for the most part, a quiet market from the start or the get-go on Monday leading up to Wednesday afternoon. Unless we have some kind of a news announcement, some kind of geopolitical event, Mondays tend to be somewhat on the quiet side. Tuesday tends to be waiting in anticipation of Wednesday's announcement, and then Wednesday tends to be quiet leading up to the announcement. So I'm not expecting a lot of widespread moves leading up to Wednesday afternoon in these markets. Can the market move? Of course it can move. Can it go down a few points, up a few points? Sure it can. But I'm not expecting any large moves in one direction or another before Wednesday afternoon. Now, on Wednesday afternoon, certainly based on what the Fed says and based on how the market wants to interpret what the Fed says and what the Fed does, we may get some moves Wednesday afternoon. That certainly can and normally does happen. The market does tend to get a little bit whippy after a Federal Reserve announcement or an FOMC announcement, so that can be expected, but we're not going to worry about that now. We'll worry about that on Wednesday. So let's discuss where we are as it relates to the upside and where we are as it relates to the downside, and what we can expect if the market begins going lower or the market begins going higher. So we'll talk about the bullish and the bearish case. So before we do that, let's go back in time a little bit and point something out that I think is extremely important. So I want to focus in on what I like to call a breakdown candle. This candle right here from the 5th of February had 294 million shares traded in the SPY. That classifies, as well as the next one, that was a reversal candle, that had over 300 million shares. Those classify as large volume days, which tells us there's institutional participation. There was institutional participation on the downside, and then the following day, there was institutional participation in the reversal on the upside. Then we had another dip down, and that's where we found final low down here on the 9th, and then the market rallied. And the reason why I want to bring this up is because we're above the important breakdown candle that had all that volume. As long as we remain above that area, and we can still use the 270-250 as a line in the sand, 270-75, that's the darker or the thicker green line below that. It's not that far away from the 270-250. We can use this general zone as a line in the sand that tells us that the market is turning bearish or the market is remaining bullish above that line. As long as we remain above these lines, the fact that the institutions had heavy volume on the way down, and we've since recaptured those levels and we remain above the moving averages, albeit we closed below the 50 slightly on Friday, but we're going to say for the most part we're in a bullish formation above the moving averages. And essentially what I can say is that this is a pullback pattern. This is a bullish pullback pattern that will generally result in another up move. It doesn't have to be a tremendous up move. It doesn't have to be to all-time highs. But generally speaking, this pullback, this type of pullback pattern, we may have another down day or two, but this will generally result in another bounce higher to the upside. Now, we've also been focused on an important level at 278.80 on the upside. I'm going to move this up slightly. I moved it up to 280.41. That's the pivot high that was made on the 13th of February. March. And the reason why is we made an attempt to get up over and above the first breakdown candle that occurred on the 2nd of February. That's important. A, the market was rejected at that point, but we weren't rejected by much. We haven't been down with any kind of severe velocity off that level. That tells me that the market still has, at least for now, somewhat of a bid underneath it. And if we take another run higher, that's going to be the line in the sand. 280.41. If we close above 280.41, this market is turning more bullish than it is today. It's not bearish today. It's not ultra bullish, but it's certainly above the neutral line at bullish, if anything. If we start closing, I would say more than one day. We need a couple of closes above this area at 280.41. If we close a couple of days up in that neighborhood, that's going to be bullish for the market. And then the market's going to want to fill this gap up here, and which is very close to the all-time highs. So we'll see. That's a long way off, but you never know what can spark on the Federal Reserve announcement on Wednesday afternoon. It can certainly spark the market. However, it goes both ways. So there's no telling what the market will do based on whether or not they increase interest rates. It can be taken both ways, and it's typically deciphered after the fact. For example, if they raise interest rates and the market goes up, they'll say the Fed feels confident about the economy. They feel confident about the markets. They're confident enough to raise interest rates. Therefore, things are good. The market's bullish. Everything's fine. They can certainly take that stand. On the flip side, if they raise interest rates and the market goes down for some reason, they can say, and this is the media, they is the talking heads, they can say that if interest rates go up too far too fast, it's going to put a strain on the market, and that's why the market sold off. And they create and develop a narrative around what the resulting move is from whatever the Fed announcement is or becomes. And then we have the good news is bad news is good news scenario. So it's better not to guess which way the market's going to go based on what the Fed does. What we like to do, and what's the best option to do, is watch the market, see the price action, see where the money flow is going, where the institutions are placing their bets, and that's typically the smart money, and that's where the market will be headed longer term. And longer term doesn't have to be months. Longer term could be days or weeks. But guessing what's going to happen after the Fed announcement is basically just a coin toss. There's no point to it. You might as well go put money at a roulette wheel or the blackjack table or something like that, because guessing which way the market's going to go after the Fed announcement is nothing other than just a bet. Now let's talk about the flip side. Let's talk about the downside. If the market begins to sell off further, it begins to wedge down more, well, we have stuff. So we have a trend line that the market's been kind enough to draw for us, and we're approaching that trend line right now. So if, for example, on Monday we touch and hold this trend line, that's going to be relatively positive in the short term for the market. We do have the 270.250 and the 270.75. That's somewhat of a safety net beneath that. I think those are important levels for the market, and I don't see the market getting through those levels without one heck of a fight. However, if it did, even below that, you have the 100-period moving average. Then you have another important pivot low, and these numbers are far down from where we are now. So, for example, this pivot low is about 90 S&P points down from where we are now. That's quite the move. I don't expect anything like that to happen, especially before the Federal Reserve announcement, barring some kind of geopolitical event or some big announcement that jolts the market. So I don't expect anything like that. I'm just giving you the numbers and the levels as I see them by looking at the charts on the screen. As it stands right now, your line in the sand is really going to be in between the 270, 250 and 270.75. If we begin selling more than that, something else is going on. I don't expect that right now, but certainly anything can happen. I just would find that area to be supportive of the market in the short term. Looking at the IWM. So the IWM on Friday put in a pretty good showing. It was up a little more than 0.5%, while the S&P 500 was basically flat. The S&P 500 was up less than 5 points, 4.68 points, or 0.17%. The SPDR showed down slightly, but that's as a result of the fact that the SPDR pays a quarterly dividend, and that dividend was paid before the opening bell rang on Friday. So the SPDRs were down slightly, but the S&P 500 was up slightly, and that's why you have a slight divergence between the SPY and the S&P 500 cash index. Just to display that, here's your S&P 500 cash index, and you can see here we closed above the 50-period moving average on the cash index. So I would expect that, and it normally happens this way, that the SPDR will just catch up to the S&P 500 cash index in the coming day or so, and that dividend will just go by the wayside, and the chart will just filter out and match up with the cash index. It generally happens that way. But back to the IWM, even against the S&P 500 cash index that was up slightly, the IWM put in a good showing. So is the IWM leading the market back to the upside? Is that what this is telling us? I think it's a little early to tell, but it's not too early to notice. If I'm looking at the S&P 500 and I'm looking at the IWM, I see not really too much bearish activity. The S&P 500 is above the moving averages, and the IWM is well above the moving averages, and also put in a nice bullish day, albeit not a tremendous up day, but certainly a bullish day relative to the S&P 500, and we're still not that far off from all-time highs in the IWM. We'll be watching this line very closely. This comes from the monthly chart, you'll remember. And if we close above this line, we'll have recaptured it in the month of March. We're waiting for the March close to make that determination. If we close back below that line, that will be very bearish because it'll be 2 consecutive months of closing back below that line. That will be bearish. That will be a failed breakout. But we can't make that determination until the close of the month of March. So my favorite market leading indicator, not so bearish. We had 3 down days after putting in a doji candle. That was a signal of a trend change. We had a short-term trend change. We were up on Friday. The question is, do we go sideways or do we continue the up move and challenge the highs that were made on the 13th of March? And if we can, do we challenge the all-time highs? Right now, there's nothing bearish about this chart. There's nothing bearish about the trend in the IWM. It's a bullish chart. Here's the weekly chart. And I'll give you a little tidbit how the institutional money looks at weekly charts. And what they look at, and daily and weekly, both, what they look at is a 50-period moving average. And they're going to stay invested as long as markets are over their 50-period moving average. Once the market gets below and begins to close and trade below the 50-day or even 50-week moving average, that's when institutional investors, money managers, mutual fund managers, pension fund managers, the big money that sloshes around the markets, once the market gets below and begins closing below its 50-period moving average on daily or weekly charts, that's when they begin trimming positions and rebalancing portfolios. That's when they begin to get nervous. As long as these markets remain above the 50-period moving average, the big money is staying invested. That's just the way it is. That doesn't mean they won't be late in rebalancing portfolios. That doesn't mean that they're going to sell their portfolios if as soon as we get below the 50-period moving average, they will sell or trim some positions. That doesn't mean that we can't be ahead of the institutional money. We can, and we normally are. I'm just telling you what they're watching with a keen interest is the 50-period moving average. We want to be ahead of the institutional money. We want to be anticipatory of where the market is going to make a turn based on all the things that are taught in the course at lazyminitrader.com. We want to know where the market's failing on the upside. We want to know where the market's going to find support on the downside. We don't necessarily have to be the first one to the party, but we want to be there early when all the fun is going on. We don't want to be late to the party. Institutional money, they may be early on the buy side, but they're typically late on the sell side. Just like when you see analysts downgrading a stock at its lows. Well, who does that do any good for? Nobody, but that's in place of them actually admitting that they were wrong. Taking a look at the VIX real quick tonight, on the VIX, we talked about the fact that the VIX was putting in a bearish pattern and could potentially go lower, and we saw it go a little bit lower on Friday, and if the VIX continues down in this fashion and we get down to that 12, sub 12, 11 and a half, 11 area in the VIX, that's going to constitute a buy area for the VIX. We want to be buying where this breakout occurred around 11 and a half or even to 11, down in this neighborhood. That's where we want to buy the VIX. If it gets down there, I will be buying the VIX down in this zone. This is a bearish pattern, and if it plays out the way I think it can, might take a little while, but if it gets down there, I will be a buyer for another move higher and volatility to expand in the VIX. As long as we continue to see downward pressure in the VIX, that means fears coming out of the market. That means the market is unlikely to have, meaning the market, meaning the S&P 500, the Dow, the Nasdaq, the IWM. As long as the VIX continues lower, it's unlikely that we're going to see any kind of a hard sell in this market. My other favorite market leading indicator being the transports, that also had an up day on Friday. So we had the IWM up, and we had the transports up on Friday. So my two favorite market leading indicators are up on Friday. Is that telling us that there's bullish activity coming this week ahead in the markets? It very well may. Typically, the two favorite market leading indicators don't fail us very often. And when they do match up, you have to pay attention. You have to take it seriously. If in fact, the transports are able to get above this level right here that we made an attempt at last week and failed. If we can get above and close above on the daily chart this level, that will be bullish for the transports, and they'll want to test most likely this important level up here, and there's some important pivots along the way. This one's close by. You have another pivot up here. These are all important areas that the transport will want to test. But the first line I put up there is the most important line. And if we can close above the high right here, then the next area of extreme importance is right up in this zone right here in the transports. So I'm watching the transports very closely. Market leading indicator up on Friday. It's at a minimum of note. We have to put it as a piece to the puzzle on the table. We'll also take a look at the Nasdaq Composite from Friday, and you'll notice the Nasdaq Composite was basically flat for the day. So we had a slight up day in the S&P, a slight up day in the broker-dealers, which we didn't look at. They were up 0.9%. So it was more than a slight up day. It was almost 1%. So a pretty good day for the broker-dealers. The Dow was up about 72 points, about 1/3 of 1%. The IWM was up and the transports were up, but the Nasdaq Composite was flat. Where are the risk assets? The main two indexes that the risk assets are found are the IWM and the Nasdaq Composite. The IWM had a nice up day and the Nasdaq Composite was flat. So there is somewhat of a divergence between the Nasdaq Composite and the IWM, both being indexes where risk assets go to play. While there's nothing wrong with this chart, it's in the upper range. We're almost at all-time highs. We were at all-time highs just days ago, above all the moving averages. There's nothing wrong with this index. The only thing I take pause at is this a bearish pattern developing that's going to play out down to the 20-period moving average? That's very possible, but we'll see what happens early this coming week. We'll also take a look at the gold market real quick, and you can see what happened in the gold market. On Friday, we went down to touch or came close to touching the 100-period moving average again. I don't feel that that's somewhat significant because we were already at the 100. We consolidated above the 100 for quite a while, a couple of weeks or so. And now, we'll see if we're going to break through the 100. And if we get below this pivot low down here, that's going to be very negative for the gold market. This little green smidgen you see on the screen, that's the activity that begins Sunday evening, going into Monday's trading. I'm making this video Sunday evening after the market opened. That's why you see the green candle developing for Monday's activity. On the bullish side, the only way this market turns bullish in a bigger way is getting above and closing above this level. So here are your brackets. We're in the middle of a range until the market wants to make a decision whether it's going to go through the bottom side or through the top side. There's nothing to do in the middle of this range. It's a very, very difficult endeavor to trade the gold market in between those brackets. Crude oil had a nice up day on Friday. We'll see if we can continue. If it gets above on a closing basis, the 50-period moving average will challenge this pivot high that comes from the 6th of March. That high is 63.64, and if we can get above that on a closing basis, the next stop is 64. Above that, and we're off to the races on the upside. If none of that happens and we turn down, $58 is in the cards, and if 58 doesn't hold, look out below in the crude oil market. And with that, folks, it's everything I wanted to and intended to discuss, so therefore I'm going to give it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.